Chapter 11. How stock investing works. Stock investing can seem complex, but following a structured process simplifies it and increases your chances of success. This guide provides detailed insights into investment strategies, mechanics, tax implications, case studies. It also includes a glossary of key terms for quick reference. 1. Set clear investment goals. A. Define your objectives. Identify why you're investing. Retirement, building, education. Clear goals shape your strategy. B. Determine your timeline. Short-term goals, 5 years. Avoid stocks due to volatility. Consider safer assets like bonds or cash equivalents. Whereas long-term goals are 10+ years. Stocks are better suited for long-term growth, as they allow time to ride out market fluctuations. 3. Assess expected returns. Match your goals with appropriate return expectations. An example: for retirement in 30 years, growth-focused stocks may be suitable. For a home purchase in 5 years, a mix of bonds and stocks might be safer. Key takeaway: align your investment horizon with your financial goals to avoid unnecessary risks. 2. Determine how much you can afford to invest. A. Analyze finances. Review income, expenses, and savings to determine how much you can allocate for investments. B. Build an emergency fund. Secure 3 to 6 months of living expenses in an accessible account before committing significant amounts to stocks. C. Avoid high-interest debt. Pay off debts like credit cards before investing, since stock returns may not always exceed interest rates. D. Start small if necessary. Example: if you earn $4,000 monthly, allocate $1,000 for essentials, $500 for debt repayment, $500 for an emergency fund, and invest the remaining $2,000. Key takeaway: ensure financial stability before diving into stock investments. 3. Determine your risk tolerance and investing style. A. Identify risk tolerance. Assess your comfort with market fluctuations and ability to handle potential losses. Use tools like risk tolerance quizzes to evaluate whether you're conservative, moderate, aggressive. Choose an investing style. Value investing. A. Core principles. Focus on identifying undervalued companies with strong fundamentals, but temporarily low market prices. B. Research process. Analyze financial statements, e.g. balance sheets, and income statements to assess intrinsic value, using metrics like price to earnings, PE ratio, or price to book, PB ratio. C. Famous example: Warren Buffett is a renowned value investor who emphasizes buying quality companies at discounted prices. D. Suitable for patient investors willing to wait for the market to recognize a company's true value. Growth investing. Core principles. Target companies with high revenue growth rates, innovative products/services, potential for market expansion. B. Key metrics. Analyze industry trends, revenue growth rates, earnings per share, EPS growth, competitive advantages. C. Famous example: Peter Lynch focused on identifying growth stories with strong potential for future earnings. D. Suitable for investors comfortable with higher risk in exchange, potentially higher returns over the long term. Income investing. A. Core principles. Prioritize generating regular income through dividends rather than capital appreciation. B. Evaluation criteria. Dividend yield, annual dividend as a percentage of the stock price, and payout ratio, percentage of earnings paid as dividends. Lower ratios often indicate sustainability. And financial stability. Assess the company's cash flow and debt levels. Suitable for investors seeking steady cash flow with moderate risk. Ideal for retirees or those nearing retirement. D. Tailor investments to life stage. Example: 25-year-old with stable income may prefer growth stocks. 55-year-old nearing retirement might focus on bonds and dividend-paying stocks. 4. Choose the right investment account. Types of accounts. Taxable brokerage accounts offer flexibility but are subject to capital gains and dividend taxes. Retirement accounts. Traditional IRA 401k. Contributions are tax-deductible. Withdrawals are taxed in retirement. A Roth IRA 401k. Contributions are made after taxes. Withdrawals are tax-free in retirement. Employer-sponsored plans, 401k, often include employer-matching contributions, but have limited investment options. B. Advantages and disadvantages. Taxable accounts allow flexibility but lack tax benefits. And retirement accounts provide tax advantages, but impose contribution limits and early withdrawal penalties. C. Platform selection. Compare fees, trading options, research tools, and customer support on platforms like Fidelity, Vanguard, TD Ameritrade. Example: if investing solely for retirement, Roth IRA tax-free withdrawals may suit you. For shorter-term investing, consider a taxable brokerage account for flexibility. 5. Build your portfolio. A. Fund your account and start investing. Deposit initial funds via bank transfer. Many brokerages allow fractional share investing if starting small. Set up automatic contributions, e.g. £100 month, to maintain consistency using dollar-cost averaging. B. Diversify investments. Spread assets across sectors, technology versus healthcare, and geographies, domestic versus international markets. C. Apply fundamental analysis. It can evaluate financial ratios like liquidity, current ratio, profitability, ROE, and valuation, PE. Use competitive analysis frameworks, like Porter's 5 forces, to assess industry dynamics. 6. Manage market volatility and risks. A. Understand market volatility. Learn from historical events like Black Monday, 1987, or the Great Financial Crisis, 2008, to appreciate systemic risks. B. Employ risk management techniques. Diversify across asset classes, stocks versus bonds, and regions. Use stop-loss orders to limit losses during downturns. Hedge risks with derivatives, like options or futures when appropriate. C. Monitor portfolio performance regularly. Rebalance periodically to maintain desired asset allocation as markets shift. 7. Tax implications. A. Capital gains tax. Short-term gains, 1 year, taxed as ordinary income. Long-term gains, 1 year, taxed at reduced rates, 0%, 15%, or 20%. B. Dividend taxation. Ordinary dividends are taxed as income. Qualified dividends enjoy lower tax rates. D. Tax-efficient strategies. And use tax loss harvesting to offset gains with losses. Maton place tax-efficient investments in taxable accounts, while holding less efficient ones in tax-deferred accounts. 8. Incorporate case studies. Amazon AMZN demonstrates long-term growth potential from innovation in cloud computing and e-commerce. Tesla TSLA highlights high-risk, high-reward dynamics in pioneering industries, like electric vehicles. GameStop GME illustrates retail investor influence on market dynamics through social media coordination in early 2021. Glossary of key terms. Capital gains tax. Tax on profits from selling an asset at a higher price than its purchase cost. Dividend yield. The annual dividend payment divided by the stock price measures income return on investment. Intrinsic value. The estimated true value of a company based on fundamentals rather than market price. Payout ratio. The percentage of earnings paid out as dividends indicates dividend sustainability. Price to earnings ratio, PE. Valuation metric comparing a company's share price to its earnings per share. Conclusion. Investing in stocks is a methodical process that can build wealth over time when done correctly. By understanding different investing styles, value, growth, and income, you can tailor your approach based on your goals and risk tolerance while employing sound strategies like diversification and risk management. Use this guide as a roadmap to navigate the complexities of stock investing effectively. This version provides detailed explanations of each investing style while maintaining clarity throughout the chapter.